Well, hello everyone. This is Tuesday, March 28th, 2017. And today we're talking about beneficiary designations as they apply to self-directed retirement accounts and some issues that arise relating to LLC control when somebody dies. In essence, this session is a lot about estate planning. So our agenda, first we're going to have a little bit of a primer on IRA beneficiary designations, and then we'll go into control and liquidation challenges for CEDRA-owned entities, and then we'll have some questions. So, retirement plan beneficiary designations. Now, if you think about it, you really know more than you think. You know who owns your IRA account. That's you. You're the one who created it. You own it. Nobody else. And you know when you pay income tax. That's when you take distributions. You know that there's a penalty for early distributions, and you know that there is a time when you have to withdraw. That's when you're age 70 and a half. So distributions from retirement plans are controlled after you die by beneficiary designations, not by your trust and not by your will. So there are three types of designations. You can designate individuals to be the surviving beneficiaries to inherit your retirement account. You can designate trusts for individuals to be the beneficiary of your retirement account, or you can designate the account to anyone else or anything else. So first I'm going to give you a bit of a 10-minute review on distribution roles. There's really just three things to remember. It's sort of like red, yellow, green, but in this case it's blue, yellow, green. True blue means that there are things that are true and things that are not true, and the IRS has established that there is a uniform table of withdrawals during the lifetime of a beneficiary or of a retirement account owner. They've established these tables using actuarial tables, so they are the standard by which we determine how distributions are done. Now, yellow means caution. When we're driving down the street, that means caution. So the caution light is on when you name a trust as your beneficiary. If you name a trust as your beneficiary, you have to pass a test to determine how fast the distributions are required. And if you meet the test, green means go. And then, of course, green means go. If your trust passes the test, it allows your beneficiary's life expectancy to be used to determine what the distributions are, and that's called the stretch out. So if your beneficiary is a young person, their life expectancy under the tables is fairly long. If they take out minimum distributions, then of course their account is going to grow. And so the distributions that they have to take are simply going to stretch out over their life expectancy. So what happens if you don't meet the test? Well, the first thing is that you have to, if you've started taking minimum distributions yourself before you die, then the distributions for the beneficiary have to come out based on your life expectancy as opposed to that of the beneficiary. And of course, your life expectancy at death is probably a lot shorter than theirs, which means that the distributions that come out have to be a lot larger than they would otherwise be. So that's the test. That's what happens when you don't pass the test, or alternatively, you have to have if you die before your life before you started taking minimum distributions, you end up having to take the distributions out over a period of 5 years. So in order to get the income tax deferral we want, and at the same time get all the personal protections and personal instructions and death tax planning we want, we have to pass the test. And how do we get all those protections? Well, that's what we're looking for with a trust. So the same test applies for the trust applies whenever you die, whether you die before or after your distributions begin. So if death occurs before you begin distributions, you must pass the test, or the general rule applies. The general rule requires all proceeds to be distributed within 5 years. If death occurs after you begin distributions, you must pass the test, or the general rule applies. But the general rule in this case requires proceeds to be distributed based on the account owner's remaining life expectancy as of the date of death, as I said before. So the impact of failing the designated beneficiary test for death before distributions begin is the 5-year rule, and for death after distributions begin, you have to use your own life expectancy, which is not a good result for the beneficiary. So how do we pass the test? Well, anytime you're trying to take a test, there are 3 challenges that you have to pass. And the first is you have to know your material. So you have to study it, you have to get a tutor, and sometimes you need to get both. So, and the second part is that in order to pass the test, you're going to have to show your work to the teacher. So the teacher has to take a look at it. And if you don't turn your work in on time, then of course you're probably going to fail the test too. And all of those things apply in this area. So to assure distributions based on the favorable life expectancy, we have to name a designated beneficiary, and that's a term of art. And we have something called the heartbeat test. If the beneficiary has a heart, then they can be a designated beneficiary. And the term designated beneficiary is kind of a term of art. That means it's somebody who is an individual. And that allows distributions to be based on the beneficiary's life expectancy. So if they inherit your retirement account, they can take out distributions for your traditional IRA over their life expectancy. Okay, so and they also have to take out distributions for your Roth IRA as well. So although you don't have to take out distributions, they do. So it's easy when the beneficiary is a person. Part 5 of the test, if the trust is a beneficiary, but we have a 5-part test that we have to pass if the trust is a beneficiary, or the beneficiary of the trust. We call this the heartbeat test. So here are the 5 parts. The trust has to be valid under state law. Means it has to be executed correctly, it has to be in existence. It has to have individual beneficiaries, meaning it can't have charities, it can't have corporations and people like that, or at the time you have to designate who the beneficiary is, you can't have charities in the trust, so they have to be individual beneficiaries. And the beneficiaries have to be identifiable beneficiaries. In other words, the trust can be a little bit vague about who the beneficiary is. The trust has to be sufficiently specific so that IRS and anybody who wants to know can identify who the beneficiaries of the trust are going to be during the term of distribution. You have to deliver the trust to the administrator of the retirement account. So if Fidelity, for example, is the trust custodian, you have to deliver a copy of the trust to them. If it's Pensco or any other custodian, you have to deliver a copy of the trust to them so that they know that you passed the test. And the trust finally has to be irrevocable on death. Nobody can have the ability to amend or revoke the trust. It has to be final. The terms have to be established on death. So if the trust qualifies for the exception, it becomes invisible as far as minimum distributions are concerned. All the beneficiaries are considered designated beneficiaries, and we can look through the trust and use the heartbeat of one of the beneficiaries to determine, or the life expectancy of one of the beneficiaries to determine what period of time over which we have to make those distributions. So, if the trust does not qualify, then we end up using the general rule, which is not good for the beneficiaries. It means we have greater income tax faster than we want, and the preservation of the tax-free accumulation of wealth inside the account is lost. So we have some obstacles and we have some opportunities. Providing a lifetime trust protections are opportunities, and using a trust can allow us to increase the stretch out capability of the trust. So why pay distributions to a trust? Well, we have some protections that we call the school bus protections, and they're based on a story called the school bus story. In the school bus story, you have to make the assumption that, and this is about me and my surviving spouse, so you have to make the assumption that I die. And when I die, I give all of my property to my spouse through my will or jointly or whatever. And so a few years later, my lovely wife has all the assets in her own name, and she's driving down the street. She's distracted for a minute, and when she looks up, she sees a big yellow school bus right in front of her, and she slams right into it. And then, of course, there are all those victims. Channel 5 is coming to look at it, and it's all on television. And of course, I told you indirectly that she was at fault because she was distracted and she wasn't looking at the road. So what happens to all of those assets that I left her when I died? Well, you can imagine it goes to all of those plaintiffs. And so that's not a really good result. But if, on the other hand, I left the property that I wanted her to have in a trust for her, in other words, if I had my own trust and I died and the trust became irrevocable and it's for her, then the assets don't really belong to her. And the result of that is that those plaintiffs can't really get to those assets. There are a lot of ins and outs to that, but that's the general rule. And so what that means then is that she's protected from creditors that she may end up. We can also provide for protection for her in the event that she remarries and gets divorced. And we can also provide some protection for her if she becomes catastrophically ill, so that she's able to get the benefit of public benefits if she needs them, and she can have a supplemental trust. So there's a lot of benefits that we can get from a trust, and all those benefits can apply to the beneficiary of a retirement account if a trust is designated as the beneficiary of the retirement account. So if the IRA does not have a trust, the IRA itself has no protections under a recent Supreme Court decision. It was determined it's a United States Supreme Court decision. It was decided that the beneficiary of an IRA has no creditor protections. The bankruptcy court can get to their interest in the IRA, and so although you have creditor protections as the owner of the IRA, when you die, the people who inherit your IRA don't have creditor protections, and the creditors can take it. And distributions from the IRA also are not protected because the creditor can simply wait for them. So why pay distributions to a trust? And that's because we can have all those school bus protections. So instead of having the distributions go to the beneficiary directly, they can go to the trustees of the trust, and the trustees of the trust can hold the assets for the benefit of the beneficiary. And if the beneficiary can be a trustee and can have the ability to hire and fire the co-trustee under certain standards, then they actually have practical control, or pretty much practical control, over the assets, but they don't belong to the beneficiary, so they're not exposed to creditors. So another reason is that we can also provide financial instructions. So if the beneficiary, for example, seems to be very young, then the trustee of the trust can provide instructions to the beneficiary as they grow older, The trust can provide financial instructions about how they're supposed to be maintained, and the trustee can take on the obligation to teach the potential, the benefits of income tax deferral and other benefits that are available for the beneficiary that they might otherwise squander. It's quite common for when somebody who owns an IRA dies, the custodian or representative of the financial institution calls up the beneficiary and says, I have this account here with $100,000 in it. What would you like me to do with it? And if the beneficiary is inexperienced and doesn't really understand what an IRA means or the benefits of long-term deferral of growth and income, then they're going to say, well, send me a check. And then, of course, they end up with $100,000 of ordinary income. So with a trustee who's sophisticated and they know what they're doing, they can teach the potential income tax deferrals to the beneficiary, and they can control and direct the deferral of the distributions themselves. Of course, you can always take out more from the IRA. So if the trustee determines that the beneficiary needs more than the minimums, then the trustee can take out more. And speaking of minimums, the minimums are minimums. There are minimums for you, and there are also minimums for your beneficiaries. So the minimum distribution rules mean that you have to make a distribution of a minimum amount every year, and that minimum amount is determined by your life expectancy. So if you have a life expectancy of, let's say, 30 years, the value of the account at the beginning of the year is divided by 30, and so you're required to take out 1/30 of the value of that account that year. The next year, of course, you will have a different life expectancy because the tables actually recalculate what your life expectancy is. So you might have, after a year later, instead of having 29 years, you might have 29.2 years, and so it goes. So you divide the value of the account by that life expectancy divisor, and that tells you what the minimum distribution requirement is. You have to take that out. You can take out more, but you have to take that out. And that's called the minimum distribution. And of course, if we have a trust, then we can take out those minimum distributions. We can teach deferrals. We can adopt an investment policy both inside the trust and inside the retirement account, and adopt a philosophy in the policy. So also another aspect of it is that having it in the trust can enable us to do death tax planning, because retirement account benefits are able to help you use up your tax exemption, the $5,490,000 tax exemption, and also state exemptions, because they are an asset. So if they're in the trust, you can actually use the credit to protect them from estate taxes. So those distributions goals drive your decisions. Do we want to provide protections? Do we want to provide instructions? Do we want to use each individual beneficiary's life expectancy for the distributions? All of those goals can drive the decisions that you make about how you structure your trust. And so a lot of people say, well, when would you not want these protections for your beneficiaries? And so, you know, if you're going to expose your IRA that's inherited by your beneficiaries to their creditors and to the vicissitudes of their lives and to their potential short-sightedness, then having a trust that's appropriately structured can really be a good benefit for the beneficiary. So now I'd like to talk a little bit about control challenges when a self-directed retirement account owner dies, because there are a number of different issues that arise relating to what happens when the beneficiary takes over control of your account, particularly in the context of self-directed retirement account investment, and in particular with regard to LLCs or other entities that you might invest in with your self-directed retirement account. In these cases, we're going to be talking only about LLCs, but the same context in general applies to corporations, partnerships, etc., that your IRA might invest in. So first, I want to talk a little bit about single-member LLCs. If you are using a checkbook LLC and your IRA owns 100% of the LLC, it's a single-member LLC, and you are generally going to be considered the manager. So the question then is, who fills that empty chair when you're gone? Who's going to be the manager? Who controls the IRA's decisions, and who becomes the successor manager? So here's an example. We've got a self-directed retirement account investment LLC. The owner dies. The custodian then knows who the beneficiary is. Well, the question then is the beneficiary qualified to be the manager? You know, the beneficiary might be qualified to control decisions on the IRA and might understand what's going on with the business investments that you've made inside the LLC, but they might not. So that's something that you need to consider about whether the beneficiary is an appropriate manager. And then, of course, the next question is, you know, if the beneficiary is going to be a trustee, if you're going to designate a trust as a beneficiary, who will the trustees be? Now, the beneficiary could be a trustee, could even be the sole trustee, but that's not always, that's not generally recommended because that means less creditor protections usually. So who would you choose as the trustees of the trust who would be qualified to make decisions along with the beneficiary or by themselves? And so that's an issue that needs to be decided when you're trying to figure out, okay, what are you going to do with your self-directed retirement account? So, you know, the beneficiary can be a co-trustee. A lot of people don't want to put strings on their assets that they leave for the beneficiary. But, you know, if the beneficiary is a co-trustee, let's say they're old enough, and when they become old enough, they can become a co-trustee. If they're a trustee and they have the ability to decide who their co-trustee is, who the other trustee is, as long as they're independent, then they do have some practical control over it. Now, having the co-trustee is a protection because that, as long as that trustee is serving, then they have, if there's only two trustees, veto power over decisions, but they can be removed, and then the beneficiary has to find somebody else who will serve. But it does give the beneficiary a lot more control over how things are done, and it converts the trustee into someone that the beneficiary feels like they have to go hat in hand to, converts the trustee into a kind of an advisor who works with the beneficiary to make appropriate decisions. So what about liquidation and buyout challenges? What happens when you have a multi-member LLC and one of the member dies? Do the beneficiary designations trigger transfer restrictions? You know, if you have 3 or 4 members of an LLC, whether they're retirement accounts or not, the owners of the LLC interests or the owners of the retirement accounts typically are co-investing together for a business enterprise. They're generally unrelated. And so they don't want third parties coming in that they don't know. And a beneficiary of a retirement account could be an unwelcome partner that shows up. So in fashioning operating agreements for LLCs, for example, it's important to consider what happens when a beneficiary takes over the account and therefore takes over control of the LLC interests that are owned by the account. Does the sudden death of an IRA member, of the IRA member's owner, trigger restrictions that are in the LLC operating agreement? What about cross-purchase agreements? How do those work with a self-directed retirement account? What about redemption arrangements? The arrangements to redeem the LLC interests from the retirement account. So here's a multi-member LLC, and we have a SEDRA member who's got a custodian, and the custodian's got the SEDRA owner. The SEDRA owner is also a member of the self-directed of the SEDRA LLC. And we have a couple of third parties. And no, we don't really have to talk specifically about what their percentages are. The percentages could be all over the map. And there's some things that we need to be very careful about if there is a transition because of someone's death. So, if the SEDRA owner dies, can the estate of the SEDRA owner purchase the retirement account's membership interests from the retirement account? And the answer to that is no, because the estate is almost certainly going to be a disqualified person, so the retirement account can't sell its interests in the LLC to the estate and liquidate its interest in the LLC. That won't work. So what about third-party members of the IRA owner? What about them? Well, that's potentially a problem, because remember that if you have a transaction between a self-directed retirement account and a person who is a disqualified person with respect to the retirement account, that's a prohibited transaction. And people who are 10% owners of a limited liability company that are also partners of a disqualified person can also be considered disqualified persons with respect to the retirement account. So if you have a third party and they own more than 10% of the LLC, they could be a disqualified person as well, because they are partners of the SEDRA owner's estate. So that can be a problem. So can the SEDRA owner's estates, can the third-party members purchase the SEDRA members' interests? Maybe not, and I explained why not. What about the LLC? Can the LLC buy the SEDRA members' interest? Well, that depends. Remember, we have the old Swanson case that says that if a self-directed retirement account and its owner own 50% or more of the LLC can be considered a disqualified person with respect to the self-directed retirement account, which, of course, you all know that I disagree with, but it is the logic of a footnote in the Swanson case. You know, that presents a problem, because we all like to be conservative in what we do, and we don't want to disqualify our accounts. So we have to accommodate the fact that the LLC may be a disqualified person with respect to the retirement account. And I should also say that a recent case repeated the same, or actually was a repeat of the Swanson case. It didn't decide anything about prohibited transactions, just like the Swanson case didn't, actually. There was nothing in that case that actually related to it being actually, they determined that the investment was not a prohibited transaction. In this new case, they ignored the whole prohibited transaction issue, so the company that was owned by the IRA owner was allowed to pay commissions to the entity that the IRA owned. So, and that, again, IRS missed the boat on actually challenging the arrangement that they were trying to correct, and they lost. So, again, it depends. So one thing that we can do is we could request, if we feel that the LLC is a disqualified person, then we could request an exemption from the Department of Labor. That might be true if the SEDRA owner were, or family members were 50% or more owners. And so we could request an exemption. If the self-directed retirement account owner owns 50% or more, we could ask the Labor Department for an advisory opinion telling us that it is not a prohibited transaction. And I will tell you that the Labor Department more than likely will tell you that 50% ownership or more of the LLC by the self-directed retirement account does not convert the LLC into a disqualified person, if you're talking about making distributions on the liquidation of the LLC or buying out the interests of the self-directed member, and even in allowing the IRA member to make additional contributions. The Labor Department has taken a very different position in its respective rulings than what the tax court has in those cases that we're mostly concerned about. And then, of course, if the third parties are not disqualified persons, they can purchase the interest of the Cedra owner's estate first. And in that case, if the Cedra member is not a 50% or more owner, then in that case, they can go ahead and purchase the Cedra member's interest after they purchase the Cedra owner's estate interest, because at that point, they're all unrelated, and the LLC can't be a disqualified person. So then there's another potential. Of course, one of the issues is, all right, we have this operating business. How exactly do we come up with the cash to pay for the redemption of the Cedra member's interest in the LLC? Where's that money come from? Well, most multi-member LLCs that are invested, let's say, in real estate don't have that much cash. And as a matter of fact, there are generally restrictions on being able to demand liquidation of your interest. And so it's going to be very difficult to come up with cash to have the LLC actually redeem the member's interest. Well, one way may be to have a trust that holds insurance on the self-directed retirement account owner, him or herself. So how that works is the beneficiary of the insurance trust is the LLC, and the insurance trust can actually own insurance on all of the individual owners, including the self-directed retirement account's owner of the LLC. So, and then the trust itself provides that when that person dies, it collects the insurance proceeds and distributes them to the LLC that's the investment holding. In that case, the self-directed retirement account's interest gets bought out by the LLC using that cash. It can also be used to buy out the Cedra owner's estate, leaving those two third parties being the sole owners of the LLC. And if the insurance is sufficient, then the estate and the IRA have been able to liquidate their otherwise non-liquid asset, meaning the LLC interest. And that can be very important to the self-directed retirement account because, of course, they have to make those minimum distributions for the benefit of the beneficiary. And it's very difficult to make minimum distributions when you're talking about LLC interests because that requires valuation of those interests every time you make a distribution. And that's hard because if you're going to make a distribution and the beneficiary is going to have taxable income, you need to know what the value of those interests is, and you've got to have an appraisal, and that can be very expensive. So we'd much rather liquidate the interests of the self-directed retirement account owner, his estate, his or her estate, and of course of the retirement account as well, so that they can go on about the business of operating for the benefit of the survivors. So if you have any questions, I invite you to contact me. Use the first call privileges to first call service to give us a call, and we're happy to answer any question. We're not on the clock. And I hope you enjoyed this presentation and it was helpful to you and useful for your future operation of your retirement account. So thanks very much, and we'll talk to you soon.